This has been so perverted, a lot of indicators don't work so well. What I did was I looked at every bubble since, stock started in the late 1700s. And the thing about what you look for, when the average bubble crash is 41% down in a matter of 3 to 6 months. So it's the first crash that tells you until they hit the floor. And 22 looked close to that. It was barely that. But that's what I'd be looking at. I think I think they push this bubble as long as they can by overstimulating in COVID, which was a short-term crisis. I think the Fed, as much as they've been overstimulating forever and getting away with it, I think where they blew it was overreacting to COVID, which would have gone away just like the influenza of 1918 to 20, almost exact same time schedule. Affects the economy for 2 years and then goes away on its own. So they put 11 trillion of this 27 trillion over the last 15 years came in those 2 years after COVID, okay? So that's what caused this sudden 9% inflation, which was way off. Inflation is going to be low as far as the eye can see by my indicators, and my indicators have been right if it weren't for this 27 trillion short-term thing, okay? So they overstimulated, now they've had to over-tighten. So this is the time we're going to see a first bubble crash finally happen after a 15-year bubble instead of 956. It should show itself in this first crash by being unusually sharp and hard. We see at least about a 40% crash, between 30 and 50, and it should happen within 6 to 12 months. If we see that, then I would say that's confirmation that this bubble has peaked long term, and it's just not just another bubble peak on the way up to new highs. So the problem for investors, we're gonna have to wait to see. I say what you gotta be now, I hate to say it, you gotta trust people like me who don't owe anybody or not gonna embarrass Merrill Lynch that I work for, anybody by saying it. Listen to people warning, look, don't look a gift horse in the mouth. We had the greatest bull market, even when we didn't deserve it. Take your chips off the table here and just give it 6 to 12 months to see if this thing starts to crash out now that it's been stretched so long. So to me, just the shape of this thing tells me this thing looks like it's getting ready to top. I used to could say, well, the demographics are going to slow and that's going to get precipitated down. No, this bubble only going to blow from its own excesses and the fact that this tightening is still going to hit into the first quarter of next year. We have not felt the tightening is not affected as much as people expected, but I warn them, we won't know till the first quarter how much this is really affected because you have to lag it by about 1.5 years, and it may even be longer now. So that's the dilemma now. So I say, be safe now. Give the economy about 6 months into the first quarter of next year. If we're still just kind of going sideways or chugging along, going up a little bit, maybe I'm wrong, and maybe they figured out a way that the economy never goes down again, which I still say not a chance in hell, but I could be wrong with that. But give it that long, be safe here. And you know what the safe place to be? 10 and 30-year Treasury bonds, and there's an ETF called TLT, which is an average of those, 20-year average. That went up. Only thing that went up at the worst of the crisis in 2008, when gold even went down 45%, only short term. If everything crashes again, that will be your safe haven. If this next first crash happens, that will do well while everything else, stocks and real estate and everything else you own starts to go down. That's the way to do. And if it starts next year and the crash looks that sharp, then you stay out for 2 to 3 years and you stay in these Treasury bonds. And when they see they exploded in the second half of 2008, that was the first warning signal that we're getting ready to turn around in early 2009. The bonds gave that ahead of stock. So I've been tracking the bond markets. They've been saying a top is coming ahead of stocks. And when we have this crash, when these Treasury bonds you're holding and making money, remember, making money when everything else, real estate, stock markets, most other investments, commodities included, and even gold down the road is going down. These Treasury bonds will be going up. And when you see them explode, that's when you're towards the end. That's the best way to gauge. We're near, not at, but near the end of the downturn. And that's probably going to be a couple of years from now. Stocks will never tell you before they go down. They're just happy, drunk, happy, party happy until they hit the floor. Treasury bond will always pay you. It's the safest long-term investment in the world. So it's not going to pay. You're not taking much risk, okay? So it's going to pay you 1 to 2% above the inflation rate. That's not what we're looking for here. I'm saying be in Treasury bond. Hey, nothing wrong with 4% when things are uncertain. I'm saying be in them because they've already proven in modern times, not way back, in the last crash in this bubble era we've been in since 1995, that in a crash, It's the treasury bonds that end up being the safe haven, and it is not gold, Peter Schiff, okay? Gold holds up in the early stages, but it goes down with everything else. So it's the only thing that went up. We're buying these because not for the 3 to 4% interest, that's nothing, okay? But it doesn't hurt. But we're buying them because they'll explode as a safe haven when there's nothing else to run to, because stocks and real estate and commodities and gold and everything else is failing at the same time. And that's what happened, especially in the second half of 2008. And that's when the Treasury bond said, we're the last game, folks. It's us or cash. And that's when the bonds went up the most in 3 months in their entire history. If you just in cash, when you have a bubble burst, an everything bubble, and that is an appropriate term that's been thrown around now. This is an everything bubble. Even 29, real estate didn't bubble like stocks because it was too hard to finance real estate back then, okay? So when you have an everything bubble, just cash, you're saying, well, I'm making nothing on my cash, but no, everything is going down, so you can buy everything at 50, 60, 70, 80, 90% off. That cash is worth more. But the only thing better than cash is a long-term treasury bond that leverages that low-risk position and over 30 years, so you get a magnified move. And again, my projection, and we've been telling people to buy the treasury bonds at 87 to 92. That was two areas we say, look, here's places where you want to buy this stuff. My projection has been they're going to go to at least 186. That's a doubling in 2 to 3 years on the safest, normally low risk, low return investment in history. And you could double your money when everything else is falling, which doubles the value of that, because anything else you would have lost instead of gaining. So this is a once in a lifetime. We have never seen treasury bonds do what I'm saying in the past, even the Great Depression, although they did great then. And we will never see it in the future. This is a once in a life opportunity to double your money in 2 to 3 years in one of the safest, lowest risk investments in the world. In other words, if this doesn't happen, you're still getting paid 3 to 4% interest on something that's very safe otherwise. And with all this deflationary, reducing the balance sheet, all this thing to slow the economy, how are you going to have hyperinflation? Peter Schiff's preaching hyperinflation out of this. That is what there's not a chance in hell about. Look at how the deficit we've run, unprecedented, 15 trillion, and our treasury bonds are still selling at very affordable rates above the inflation rate. The government can't afford to ever, and I mean ever default on these damn bonds. And you know what the reason they won't when corporations and other governments will? They have a printing press. So short term, they can print money to cover these, even if it hurts the dollar a little bit. That doesn't matter. They can't let these treasury bonds fail. It's the way they have been able to get through this crisis and still sell money to cover their deficit. And they're going to see, you think they got deficits now? They're going to have bigger deficits. They need that treasury bond to be solid as gold. They will never, ever default, and they don't have to because, again, a corporation can't print money if they get in trouble. If they get in trouble and turn around and sell stock or sell bonds, they're going to have to pay a humongous premium because they're in trouble, okay? U.S. government can be in trouble and still sell these bonds for 3.5% a day. Oh, my God. The U.S. government in particular cannot not pay these bonds principal and interest. People would have said 20 years ago, if the government ran this level of deficits, 9 trillion, or whatever over 15 years, that we wouldn't be able to float bonds. No, wrong. We're still the best house, and this is the most important statement I can make. As bad as we are, Europe's got much higher debt ratios. Japan off the chart and have been doing this for a long time, living off printed money. We're still the best house in a bad neighborhood, and our safest bonds therefore become the safest, best bonds in the world. That's why you buy them in a crisis, and that's why you sell them. People saying, well, Harry, I'm buying a 30-year bond. I can't hold it for 30 years. I'm not telling you to hold it for 30 years. I'm telling you to hold it for the next 2 years plus in a crisis, and I'm going to tell you to sell those, and then you get back in stocks and real estate when they're fairly valued for the first time in 20, 30 years. The U.S. dollar and our treasury bonds are the safe haven. If somebody tells you to run to gold, I say, hey, have a little bit, okay, if you want. There is no way in hell, if what I say happened, we have this big crash, gold's going to be the safe haven. Here's my rule, 1.5x. the stock crash, the recession and unemployment, everything's going to be 50% worse this time. This is the last downturn we need to clear all the excesses from the great baby boom era and the greatest bubble boom in history and all these bubbles. And by the way, we will never see bubbles, any of us or our kids, for the rest of our lifetime. They are rare, okay? But we have to flush them out. They're still going because we're still feeding the monster with this $27 trillion, which nobody talks about. $27 trillion. If you say, well, Harry, the economy's okay. Well, if it costs $27 trillion, do you think that's 9% a year, by the way, over that time period? You're going to spend 9% to grow 2 to 3% of the economy, and you think that's a good deal? It may have avoided a recession or a depression, but it's still a bad deal. It's still a huge, horrible investment. And we're going to pay for this, whether slowly over time or a big crash. And you know what I want? I want the big crash, take a big dump and get it out of the way. That's my view. I don't want to suffer this and this high debt ratios forever. And they weigh down any economy, any company, okay? We can flush out, and it's not the government debt's going to go away. It's all the private debt is 3-to-1 to government debt. Private debt around the world is going to disappear in massive amounts and take a huge load off the economy. So it's not just the millennial demographics driving us again instead of the baby boomers. We have a much healthier, lower debt economy to profit from it more so. All you have to do is get out of the way, be in cash if you're really confused, be in long-term treasury bonds if you're really smart, because most people are going to listen to Peter Schiff and buy gold and get their ass kicked, at least partially there. This is not free market capitalism when the government decides what interest rates are. And they actually affect the long-term rates way more by all this. They're working on the long-term rates even more than the short-term rates. So unless you think Ben Bernanke and all these Fed chairmen, Jerome Powell, are smarter than the whole entire free markets that have made us rich, who are you going to bet on? These guys never had to run a business, and they're determining the economy. Who are you going to trust? I say free market capitalism. We have thrown it under the bus, and this crash is going to have to go down enough to get people to see it wasn't worth it. The free money was not free. We got the biggest ass kicking since 29 to 32. It looks like it's free. It looks like it's working now. That's why I want this crash to happen, to get people back in reality and to prove that you can't live on printed money and we can go back to a real economy. We have not had a real economy since 2008. Who's the biggest bubble in the world? China. China's going to go down. I feel very sorry for the Chinese people. A lot of them have 1 or 2 empty homes on top of their little dinky home. They're going to get crucified. They have 75% of the net worth in real estate. Their real estate bubble is going to go down way more than ours. Ours might be 50 to 60%, and that's crucifying. Theirs is going to be 70 to 80%, and that is death-defying.